Hey everyone, welcome back to the Poplar Report. I am in Kenya still, but I have been able to kind of start catching up with everything that's going on over in the United States. And a bunch of you did ask me to kind of chime in on what's going on with the bank runs, as I am an accountant, a tax accountant, and I wanted to again give you my 2 cents of 5 reasons why this is a really big deal, why the Silicon Valley bank run is a big deal. We're going to go through those and how those could impact you, and you're going to want to pay attention to this because it's big stuff. This is the second largest bank that has defaulted in American history, really. So we're dealing with a pretty big situation, and the contagion, this spreading to other banks, is very real and is what a lot of financial people are talking about on the Wall Street Journal and these type of places. So let's jump into it. This video is brought to you by Genesis Gold Group. I keep warning you that the banking system out there is a giant Ponzi scheme, and this is exactly what we're talking about. If you want to talk to Jonathan and his team down at Genesis Gold, you can find them down in the description down below. They can help you move your retirement funds out of stocks, bonds, risky assets over into physical gold, physical silver, and that might be a wise thing to do. You can find them down in the description down below. So the 5 reasons why this issue with Silicon Valley Bank is catastrophic. They had a $209 billion worth of assets. Now, if you've watched It's a Wonderful Life, my cameraman has not seen it, and I just started just staring at him. But it's just like in that movie. You know, the money's not here in the bank; it's in so and so's house. It's in the other bank, the other people's houses. They borrow the money that you deposited, and you have to wait for them to pay it back in order for you to get that money back. Now, on a banking system level, we're talking about billions and billions of dollars of assets. We're talking about major institutions making deposits here at Silicon Valley Bank, and they're loaning it out to tech startups. Now, when they loan it to tech startups and those tech startups can't pay it back because, I don't know, they don't actually make money, that's a problem. Well, what happened was a whole bunch of people, including major institutions, started saying, well, we want our money back. We deposited money with you. We want it back now. Of the $209 billion worth of assets, on Thursday, depositors wanted $42 billion back. Now, they had some liquidity. They had some cash on hand, but they didn't have $42 billion worth of cash on hand. So they had to say, sorry, we can't do it. Now, this is something that the U.S. government actually has a program for, the FDIC. You know, you see that at banks, you know, this is FDIC insured. So basically those bank deposits up to $250,000 per bank depositor is guaranteed by the federal government, which of course immediately you're going to go, hey, wait, that's you and me. Yeah, that's right. You and me are going to pay the depositors because Silicon Valley Bank was so woke that they couldn't actually have liquidity. They have so many things on their website about how they're all about equality and diversity and all these other things, but they're not really about actually having the assets so that they can actually pay out to people. Now, so this is the big thing. The first big item of why this is going to impact more out there is tech startups. Tech startups have borrowed money from the bank, and they do need to continue borrowing money from the bank because a lot of them don't actually make money. Twitter is a perfect example. It still hasn't ever made money. And you say, well, how is it still in business? If a business doesn't make money, how do they stay in business? Well, they just keep borrowing more money. They keep going, well, we have more revenue coming in, so we can borrow against that revenue. And you say, well, but you don't have any profit. Yes. So lots of foreign investors are going to pour money into tech startups like Twitter, for instance. Lots of people in Saudi Arabia have put tons of money into Twitter. And so one of the big things about this Ponzi scheme that the United States is running with its economy is we're basically sucking in investment from around the world. People are making money in all their countries, and they're investing in the U.S. stock market. They're investing in U.S. banks. They're investing in loaning money to American tech startups and other businesses, pipe dreams, basically. So we're basically we're fleecing the whole world. It's like one giant scam. We're taking their money when they invest in dollars, when they buy dollars, and we're also taking their money when they invest in our stock markets in companies that don't actually make money. So if the tech startups don't get their money, they're going to fail. And if they fail, that means a lot less foreign investment, a lot less money flowing from around the world to the United States. And that's a big deal. That will devastate our economy, because our economy is one big Ponzi scheme. And when people stop investing in the Ponzi scheme, it collapses. So be aware of that. Tech startups and other companies that have borrowed money from this company, and we're hoping to borrow more, and also they have actually loaned money. We're going to get into that. Some of these companies that have loaned Silicon Valley Bank money, the question is whether they'll actually get their money back. That's a big deal. Second thing, bank runs are contagious. When people start feeling a little nervous about their money in banks, they start doing one thing, and this is something that, unfortunately, the only thing you really can do in a bank run is beat everyone to it. That's the only thing you can do, is get your money out first. And I am going to recommend doing that. Get enough money out of the bank that you can cover your expenses. Now, do you want to be holding dollars? That's not a great thing to be holding, but it's a heck of a lot better to be holding than promises from a bank for dollars. I think that it's much more advisable if you can get your hands on actual silver coins, silver or gold coins, bars, physical assets, food always, of course, electrical systems, anything that you can get your hands on that's actually something, not just paper. Bank runs are contagious, and we're already hearing rumors out there, and this is how it goes. All you need is a rumor about a bank, and then people start going to the bank and starting to pull their deposits back. And once other institutions or other people start pulling their money out, the liquidity ratio starts dropping dramatically. We start seeing that they have a lot less assets, a lot less cash on hand, and that makes even more people nervous. And so more people pull their money out. And eventually it gets to the point where the FDIC has to step in, and that's what they've done with Silicon Valley Bank, is the FDIC has stepped in and said, we're going to take over the bank. We're going to take over the bank, and we're going to start paying out to everybody who wants it. That's and they're going to take all the assets. Supposedly the assets are worth more than the amount of deposits that they have to pay out, but we're going to find out whether that's actually true. How much of the assets on these banks' books are actually fake assets, or assets that are dramatically overvalued on paper than what they actually are. If you have a whole bunch of shares in tech startups that don't make money, are those shares really worth what you think they are? If you own 1/3 of the company, and there's only a tiny portion of that company actually freely traded, if you try to sell 1/3 of that company, and people look at the books and they're like, we don't want this. Well, friends, if you own 1/3 of a company that actually has more debts than income, that can actually be a negative value. I know it's crazy. You can own stock where you are on the hook for more money than it's worth. So it's not a positive amount of money that your stock is worth. It can actually be a negative number in certain circumstances. And that's a crazy thought, but it is the truth. So Bank of America, people are talking about, do they have enough money on hand? And so people are going out there and they're starting to pull their money out of Bank of America. Secondly, First Republic. People are looking at First Republic and asking, do they have enough? Wells Fargo. Now, whenever we start talking about banks, malfeasance, you're going to go, is it Wells Fargo again? They keep getting fined for doing all sorts of shady stuff. And if you think that they have enough liquidity on hand for a bank run, you're wrong. Wells Fargo is under the gun, and they are massive. If people start pulling their money out of Wells Fargo, that could cause serious problems. A bunch of you are probably members of Wells Fargo or have deposits there. First Republic, Wells Fargo, Bank of America, they're talking about regional banks out there. Will the regional banks have enough assets to cover any bank runs? Number 3, like I said, so Silicon Valley Bank has been taken over by the FDIC. So the FDIC has seized their assets and said, okay, we're going to pay out on these on what's owed, because we have all these assets here, which should be more than what we have to pay out. Now, we may take some time before we can get all those assets liquidated, but We're going to find if that's true. But here's the problem. The FDIC only has about 2% liquidity. So of all the assets that it is insuring, it has about 2% of that cash on hand. So if more than 2% of the assets that are insured by the FDIC suddenly go into default, and let's just say Silicon Valley has eaten up a good bit of that already. If we have Wells Fargo go down, if we have First Republic or another major bank go down, they may step in to insure those deposits, but they may not have enough liquidity themselves to pay out on these deposits. Do you see a problem with that? And we're going to need Congress to ram through a massive spending bill, sort of like what they did with in 2008, where they just did this massive bailout. We may need a massive bailout out there. Now, how is that going to get funded? They're going to have to sell a whole bunch of treasury bills, except, oh, that's right, we have a debt ceiling. They can't sell more treasury bills right now. So they're going to have to raise the debt ceiling, if everyone's on board with that. Then they're going to have to sell a ton of U.S. treasuries to cover this. Is that going to help inflation or hurt inflation? You be the decider on that, right? So the insurance out there, the FDIC, is about to go defaulting themselves. That's a problem, folks. That's a massive problem. So if you think your money is safe in the banks that they are in right now, more power to you. I'm going to say it is a risk. You should definitely have cash on hand 2 months. Cash on hand 2 months of your expenses around the home for making your rent or your mortgage payments. You had better have 2 months cash on hand. If you don't, I think that is a risk. Now, if you have that in silver or gold in your home, or if you have that in liquid assets that you can sell very rapidly, that could also work as well. But you need to have cash on hand. You need to have assets that you can liquidate quickly, because if your bank goes down and the FDIC says that people are going to be able to start withdrawing on Silicon Valley Bank deposits on Monday. When they start doing that, we're going to start seeing the FDIC's bank account themselves start dropping. Their cash on hand is going to start dropping. And how much do you want to bet those extraordinary measures out there that are made to elongate the need before the debt ceiling comes? How much do you want to bet that a bunch of that money sitting in the FDIC is what's been tapped? Yeah, tapped. They're borrowing against that money in the FDIC in order to cover the debt ceiling. I would not be surprised if that is the case out there. I haven't heard one way or another on that, but it's a whole bunch of cash just sitting there. And when they're doing extraordinary measures, could they be using that cash that's supposed to be sitting there for an emergency? Could they have spent that already? Or in the planning stages of spending that? Could that be what is part of what's going to take us through the July before the federal government runs out of cash? I don't know. Number 4 here, folks. Depositors tried to withdraw $42 billion on Thursday from the Silicon Valley Bank. They had $209 billion of assets. Now, this is kind of what happened. That is 1/5 of the assets. If you want to show me a bank that has 1/5 of its assets in cash, that was just Thursday. That wasn't counting Wednesday and before. On Thursday, people tried to pull out $42 billion. There isn't a bank in the United States that could handle that type of withdrawal. So when I say that all it takes is a rumor to bring down a bank, it's not that any bank doesn't have enough liquid assets. It's the fact that none of them do. None of them have the assets for everyone to start pulling their money out simultaneously. If you pull out 1/5 of a bank's money, they don't have that in cash. They're not sitting on that big of a cash pile. No one is, except for maybe like Warren Buffett, who's waiting for the stock market to crash, okay? He's sitting on a whole bunch of cash. Some of these trading banks might be sitting on a whole bunch of cash, but that is probably parked somewhere in U.S. Treasury bills or something like that. No bank has that kind of assets. So all it takes is for a serious rumor to get started about any bank and institutions start trying to pull their money out, it's going to all collapse. One big Ponzi scheme, like I said. Number 5, crypto. Cryptocurrencies is already impacted. And now you're probably saying out there, I don't have any cryptocurrencies. Now, some of you do, okay? So that you're already paying attention. But those who don't have cryptocurrencies, I have like $20 worth of Ethereum at this point that I bought because I got like, half of it given back to me or something like that. So for investing in it. So I have like $20 in Ethereum, but that's all my crypto assets, but I'm paying attention. Why? Because the USDC, which is one of the cryptocurrencies, now there's 2 types of cryptocurrencies. Generally speaking, this is oversimplification. There's cryptocurrencies that are kind of like used for kind of investing, sort of. The value can go up and down, Bitcoin, Ethereum, all these other coins. Then there's something called stable coins. These coins are pegged to $1 or they're pegged to another currency like euros or whatever. These are not run by central banks. These are not run by banks. They're run by these private quasi-banks, okay? Now, the USDC is supposed to be 1 USDC equals $1. And people use this as like, as effectively like a dollar. So they have to keep assets that are going to stay stable to the dollar. You'd think that they'd be sitting on a cash pile of US dollars, but that's not exactly how they run it. They had a bunch of US dollars deposited at Silicon Valley Bank. $3.3 billion sitting at that bank. That's a problem. That's a problem. They went to withdraw that money out and they couldn't get it. And the USDC, which is supposed to be 1-to-1 on the dollar, stopped being 1-to-1 on the dollar. And it just broke. It's called a peg. It's supposed to stay stable to the dollar. And when it moves, that just breaks all faith that everyone has in there. It's not supposed to be an investment up and down. People are supposed to be able to use it like a dollar. And this is why this is so significant. Not just because cryptosphere is going to get all messed up because of this. They're looking at getting all those assets out of it from the FDIC. So don't you go crying about those billionaires and millionaires and all that kind of stuff like that. But if the private stable coins fail, what do you think is going to happen next? They've already been talking about the U.S. government wants to issue their own stable coin, which is a digital dollar. So when we see private stable coins starting to break, we're going to see the U.S. government, the Federal Reserve, step in and say, hey, we can issue a stable coin that is absolutely going to stay stable. It's going to be 1-to-1 to a dollar, no change. Why don't you use ours? Use ours, and in fact, we can use ours for all sorts of stuff. Everyone can use it all day long. We can give out stimmy checks on in this stable coin. We can do bank transfers on a stable coin. We can do all sorts of stuff. So when crypto starts stumbling, we're going to see the federal government looking very eager to step in and say, hey, we have a solution. And of course, that's going to usher in them being able to track everything you buy and spend on the blockchain, and they're going to be able to block your purchases. They're going to be able to say, no, we gave you that money to buy food, and you're trying to buy a motorcycle with that. That's not going to work out. They're going to give you a stimmy check, and it's going to be a stimulus for whatever, inflation stimulus. And you're going to need to spend that on certain things. Or they're going to start saying, well, we don't want anyone buying certain things. Boomsticks or, brass and lead that go in boomsticks. We don't want anyone buying those things, so we're just going to ban that on the blockchain. You can't spend it at certain stores. Even if it's your money that you earned at your job. The U.S. stable coin, issued stable coin, the digital currency, is a massive threat to civil liberty. And you just watch, they are just chomping at the bit to jump in and start offering that as a solution. All right, folks, I'm going to keep you updated as things roll. When we start seeing, if we start seeing some other banks start defaulting here, we're going to get this out to you. And I'm going to be keeping a hawk-eye look at the FDIC assets to see if they start dropping. If we start seeing we're going to start tracking the FDIC assets, because the next bank or the bank after that defaults, may not have any cash coming from the FDIC. The FDIC may want to step in, but they may not have any cash to do so. Where are they going to get that cash from? They're going to get it from creative solutions. And I promise you, it's going to come out of your pocket one way or another. And you need to be paying attention because the US dollar and the currencies of the West are going to be impacted by this. What's the next bank? I don't know. It could be yours. Make sure that you have at least 2 months cash on hand, preferably in, you're going to have, at least 1 month cash on dollars. And then after that, it might be good to have that in silver or gold or something stable like that. So that you can liquidate that into dollars and make your pay off things. But usually it can take a couple weeks to liquidate whatever you have in silver, gold, or whatever like that. So you don't want to be caught flat-footed because unfortunately you can't pay mortgages, you can't pay rent in silver coins at this point in most places. All right, so just watch out for yourselves, watch out for your families out there. Make sure that you have some food stocked up because that's what you're going to have to buy. If you can get ahead on certain bills or anything like that and get a discount, that might be a good idea to do as well. Do what you can out there, folks, but keep your eye on what's going on, and I will keep you updated as best I can. All right, folks, thanks so much for watching. If you found this video to be useful or helpful, you might want to check out this other video right here. I'll see you over there, or I'll see you later. Steve Poplar out.